Much, ladies and gentlemen, and welcome to this particular session. For those of you who have never met this Chief Ninja, my name is Dr. Joshua Aura. I teach at RCM. Yeah, I teach at RCM many papers. Yeah, I teach financial reporting, advanced financial reporting, financial management, advanced financial management, business data analytics, and of course, most of you must have watched my videos where I'm covering some subjects like auditing and assurance, advanced auditing and assurance. I also run one of the most successful audit companies, audit firms in Nairobi at Westlands. If you go to Westlands at Haven's Court, it's called Haven Court, suite A3. You'll be able to get Aura and Co. Aura and Co has been in the business for some time, and we are now known in the market. Some of our clients are, for example, Kenya Medical Practitioners and a Dentist Board or Union, KMPDU. And some of these 5-star hotels like in Mombasa, I mean, great place. And I look forward to you guys once you clear your CPA or those who are working, whenever you're looking for external auditors or whenever you've got serious tax matters which need somebody to go to the tribunal on your behalf, always think about Aura and company. But we are here today to talk about financial reporting. Financial reporting and advanced financial reporting, there is no way, ladies and gentlemen, you'll be able to do very well in the industry if you are not good with standards. The first thing you need to do if you want to become a very good auditor, a very good financial reporter, a very good tax practitioner, you must start with those IFRSs, you must start with those IASs. It's in that regard that I would want us to revise a few questions which will be able to help us to understand these IFRSs, and I would want us to revise the questions that were done last semester, December 2024. December 2024, question number 1. And I'll brush through them very, very fast. Last semester's exam was the easiest exam that I've ever seen. This was a straightforward exam. Both theory questions were easy, and the quantitative questions were really, really easy. All right, and I'll be able to demonstrate within 30 minutes. We should be able to clear the theory. So we are told here with reference to the International Financial Reporting, IFRS 9, which talks about financial instruments, recognition and measurement, explain the following ways of measuring financial assets that are investments in debt securities. Now, please, ladies and gentlemen, listen and listen to me very well. We have a standard called IFRS 9. IFRS 9, which is what here? Financial instruments. Now, as you'll be able to see, a financial instrument is a hedging tool. It is a tool that we use to hedge against what here? Risks. Against risks. And some of these particular instruments that we shall be using to hedge ourselves as a firm against risks will be, for example, bonds. So as RCM College, given that we are really now a big college, we need to start analyzing our risks. And when we realize, for example, that we have taken so much of bank loans, right? And we realize, hey, what if in this case here we are a listed company? Instead of relying on bank loans, why don't we issue bonds? Why don't we issue bonds? Please listen. Why don't we issue bonds? So if we issue bonds, which basically are contracts that we're giving to people out there, and then they give you money at a given return, all right? So they have given us like 5 million Kenya shillings at 14% per annum. At 14% per annum. So we are bonded to them for a number of what year? A number of years. Now, IFRS 9, given that this will be like not to like, but it will be a financial liability. We are required in this case to do what here? We are required in this case to be paying these people back. So the people who have given us, who have taken these bonds from us, who have given us money, they will be taking this as a financial asset. Remember, an asset is something that you own or you control. Something that you expect to get what here? Cash flows from in the future. And of course, the cost can be measured reliably. So anytime we talk of an asset, if it's a cow, if it's a vehicle, remember, the cost must be measured reliably. You must be owning it or controlling it, and you must be getting some cash flows. People are paying transport, you are getting cash flows. Otherwise, if it's a bus that is just parked somewhere, you are not able to get any cash flows out of it, then automatically that will not be an asset because it's not helping you. All right? So these particular bonds you have given out there, we are going to be paying the bond holders. So the bond holders will be able to treat these as what we call a financial asset. And if it's a financial asset, then it shall be accounted for under IFRS 9. Now, please listen, my good students, listen and listen to me very well, because we employ people in our audit firms. Yeah, and the people that we employ, we have to interview them. And most of them, they fail at this technical area of interpretation of IFRSs. So when we talk of this financial asset, how shall we be able to account for financial asset? Now, so it depends on, look at what the question is asking here. Very, very easy question. Very easy question. This one here, our student, I would have put all the marks. Explain the following ways of measuring financial assets that are investments in debt securities, bonds here. So at amortized cost, remember at amortized cost under IFRS 9, we shall be required to do a loan amortization schedule. So we can only account for a financial asset under IFRS 9 if, number one, please listen to me, if, number one, we are going to hold the bond, we shall hold the bond to maturity. We shall hold the bond to maturity. That this bond is a 5-year bond. We, as the investors in the bond, we don't want to sell the bond in between. We are going to hold it to maturity. And when we hold it to maturity, what cash flows are we expecting? What cash flows are we expecting? The cash flows that we are expecting will be solely for payments of principal and interest. What we call the SPPI test. SPPI test. That we are going to have this bond to maturity. We are not going to sell it in between. So to maturity, we shall only be receiving interests in between, and then we get the principal being returned back. So the business case, we talk of business case. The business case here is to receive interest and what we call principal. If that then happens, we shall be able to account for this financial asset or financial liability under IFRS 9 using amortized cost, where we do a loan amortization. We amortize it to the very last cent when our loan will be paid back. If I read the answer, ladies and gentlemen, this is the answer here. We are told IFRS 9 ways to measure financial assets investments in debt securities at amortized cost. It is used when the company wants to hold the asset until maturity and only collect interest and the principal. The concept of solely for principal and the interest, SPPI test. SPPI test. Value is adjusted over time using interest method, not market price, because the asset is not available to be sold. Example, a company buys a 5-year government bond and plans to keep it to the end. It gets fixed interest every year. So at amortized cost, ladies and gentlemen, what are we saying in this case here in terms of valuation? We've been able to know very well that first of all, the bonds that you can use amortized cost are those bonds that shall be held to maturity. And the business case, the person in this case here was the bondholder, will only be receiving the interest and what we call the principal. And then, of course, when this interest is received, or paid, so if it is interest paid, of course, you shall be able to debit the interest expense account, and then you credit, in this case here, bank, if you paid. So first of all, ladies and gentlemen, are we in agreement regarding this amortized cost? Regarding this amortized cost, are we in agreement? I would want to know whether you are following the amortized cost, or would you want me to explain further? Please talk to me. If you want me to explain further, here I am. The Chief Ninja will be able to explain. Because these are things that you have been able to handle practically. You've been able to handle practically. All right. Just a moment, one more. Sorry for that. It's my doctor who treats my kid who was calling. Thank you. So we continue here. So whenever we talk of bonds which are held to maturity, please listen, ladies and gentlemen. Normally for risk management, we shall issue a bond at time zero, but we don't have an intention of staying with this bond for 5 years, for example. We issued it, but when in this case here, we realize that we can get a better provider of capital in year 2 or in year 3, we were going to sell. So if you're going to sell, then it means that we are not holding this bond for principal and interest amounts only. No, we have another objective. We shall be able to get our principal back. We shall be able to get, in this case here, our interest, yes. And then, of course, because you have a motive of selling, there is a possibility of capital gain. So the business case there is different. But I'm trying to explain the first model, which is called amortized cost, which is a model where this investor does not have any intentions of selling the bond. The bondholder will stay with this bond to the end of the period. So if the bond investor here is going to stay with this bond to the end of the period, then we amortize. We use what we call amortized cost, where we come up with a loan amortization schedule, which will be able to show us the interest to be paid. And once we get this interest to be paid, what do? The accounting bit will be to debit the interest, and then we credit, in this case here, bank, assuming that we did what year we paid. Now, ladies and gentlemen, then allow me to go and pick the second scenario, and then you tell me, in this case here, what we need to do. Look at the second scenario. The second scenario is at fair value through OCI. Fair value through OCI. OCI stands for other comprehensive incomes. Very easy. Now, ladies and gentlemen, remember how we normally do our income statement. So our income statement, we have sales. We have, in this case here, for example, cost of sales. We subtract, we are able to get gross profit. Then we have operational expenses, etc. Then we get, in this case here, what we call net profit. So after we get net profit, it will be very, very important for us to come and think of other comprehensive incomes. So for us to get what we call other comprehensive incomes, we need a section of OCI, other comprehensive incomes. Why do we need other comprehensive incomes? Please listen. This is RCM College, assuming that we have our own building. If we have our own building and we happen to be having many shareholders within RCM, and then this building we call a valuer who is able to say, hey, this building last year was worth 50 million. Hey, this year it is worth 80 million. You see, there is an increase of 30 million. There is a gain, a revaluation gain of 30 million. This revaluation gain of 30 million, I can't take it here. If I take it to the profit or loss, what would happen is that these shareholders would want to be paid a dividend out of this revaluation surplus. And yet there is no money that may forthcome. I'm not intending, this capital gain or revaluation surplus of 30 million, I can only enjoy it when I sell the building. So I'm not intending to sell the building. I've only called in a valuer. And if I've called in a valuer and the valuer has been able to tell me, hey, now this building of yours has appreciated, there is no problem. But what I can't do is to take this appreciated amount of 30 million and put it in the profit and loss. That will be very, very wrong in terms of accounting, because the shareholders, out of this net profit, they will demand to get dividends. And that is why we say for these long-term assets, assets that you are holding on to without an intention of selling them in the near future, or you have tried in this case even to sell them, but you're not able to get a market easily, then their revaluation surpluses will go to what we call other comprehensive incomes. Other comprehensive incomes. So the same is applicable with these bonds. So whenever we talk of bonds, ladies and gentlemen, we must be able to appreciate this. Look at this. Fair value through OCI. It is used when the company plans to collect interest, but we're not so sure of, but might sell the asset before maturity. So of course, the interest will go to the profit and loss account. The value changes will go to other comprehensive incomes. The value changes, the interest. Ladies and gentlemen, please listen and listen and listen and listen to me very well. I'm a bond holder. This bond holder, I'm not so sure that I will be able to have it till maturity. I may sell it anytime, but I'm not so certain that I'm going to sell it like this year. And then we have in this case here a valuer. So this interest for the years that I will be having this bond, if it's a 5-year bond. So we have in this case here, year 1, year 2. So perhaps I get interest 1 here, I get interest 2 here. In year 3, I think of what here? Bringing in a valuer. I bring in a valuer to come and do what here? Value this bond. So assuming that this bond, ladies and gentlemen, in this case here was worth 10 before the valuer came on board. And with the valuer coming on board, now it's worth 15. Meaning that there is a value increase of 5. Value increase of 5. Now, please, my students, listen and listen to me very well. This is just but a value increase. I have not yet sold this bond. So what then this would mean, in accordance with IFRS 9, I should be able to come and debit my income statement with the interests here. All right. And then, of course, I credit bank because I'm paying. Incomes, OCI, which is a bit different from this from and 3, where we have a fair value through P&L. Through P&L, now these are those assets that you're able to sell quite fast. Yeah. If I want to sell it today, I'll be able to sell it today. So at fair value through profit or loss, used when the company buys and sells quickly, to make a profit. You're buying and selling quickly to make a profit. All gains or losses go to profit or loss immediately. Go to profit or loss immediately. Ladies and gentlemen, please listen. I can see my internet has an issue, but are you guys able to hear Mwalimu? Are you guys able to hear Mwalimu very well? Are you guys able to hear Mwalimu very well? Are you guys able to hear Mwalimu very well? Ah, great, great, great. So the students who did this paper, were they able to give us that kind of an answer last semester? That for, it's all about the business case. It's all about the business case. For those bonds or debt instruments that are unable to sell quickly, if you are able to sell quickly, take everything to P&L. So we say even the fair value, it will be fair value through P&L, through P&L. If you're able to sell quickly, then in this case here, use IFRS 9, the concept of fair value through P&L, because I sell quickly, I recover my profits. If it is shareholders, I pay them their dividends out of this. But in this case here, if it is a bond which I will hold on to, till maturity, then automatically this is a bond that should be analyzed using amortized cost method. You amortize it, you prepare what we call a loan amortization schedule, which I'll be showing you how to do it later. Today, I'm only looking at the theories. And ladies and gentlemen, if it is a long term, I don't want to hold this bond for the long, I don't want to hold it till maturity. I don't want to hold it till maturity. I may sell it, but I'm not going to sell it like year one, like year two. It's a long term. It's a long-term bond. So if it's a long-term bond, which may necessitate calling in of a valuer, then that one will be fair value through OCI, fair value through other comprehensive incomes, fair value through OCI. So now, are we in agreement? Have you guys been able to pick a few things here and there? And you'll get this concept in AFR. You know, the financial reporting standards in FR and AFR are the same. They're the same. They're the same. Actually, most of the things, students understand them better when they are in AFR. So have you guys been able to get something now out of this which can help us in future, in answering future exams? Have you been able to understand? Have you been able to understand? You can simply say Y for yes. Y for yes. Have we been able to follow? So for those students in this case, you would want to join, as I wait for you guys to mention something there, to join the very best college for CPA. Don't hesitate. It is RCM College. It is RCM College. So RCM College, ladies and gentlemen, please get in touch with us. Our classes will be starting on the 2nd of May. 2nd of May. We happen to be having early bird discount. We happen to be having early bird discounts of 10% if you're able to pay. Is it within today? I'm not so sure. You need to call this number to ask for early bird discounts. And once the early bird discounts end, we don't extend. We don't extend. We don't extend. Thank you. Then allow me to go to second question. So the second question, they asked us a very, very tough question. Tough question for students who are doing intermediate, but very easy question for students who are doing AFR. International public sector accounting for the effect of changes in foreign exchange rates provides a clear guidance on how entities should translate monetary items and non-monetary items, as well as the treatment of resultant exchange differences. With reference to the above statement, explain how monetary items and non-monetary items should be translated and the treatment of the respective exchange differences. Now, ladies and gentlemen, please listen. First of all, you must be able to know how to differentiate between monetary and non-monetary. Non-monetary assets are like buildings, the property, plant, and equipment. These are figures. These are assets these are assets that we have, yes, in our statement of financial position, and we even have money against them. Like you're saying, our motor vehicles, our land and the buildings here are worth 30 million. You'll be putting that figure there. But that should never deceive you that land and buildings is a monetary asset. No. Is a monetary item. No. It is a non-monetary item because I don't intend to sell it to recover that money. And even if I was to sell it today, I may recover less than the 30 million or even more. The figures that are here, like 30 million, they are mere approximations. They are called non-monetary items. Monetary items, ladies and gentlemen, this will be the cash that I already have today or the cash that I expect to receive in the near future or pay in the near future. So for example, like receivables, if I have receivables of, say, somebody owes me 20 million, not unless this person is another one, they're bad people. I expect when this time comes, I should be able to get that 20 million the way it is without any negotiations. So first of all, you need to appreciate the difference between monetary and non-monetary. So for us to be able to understand this very well, you'll allow me to read this just kidogo. So tunaambiwa, monetary items are items that represent the right to receive or pay a fixed amount of money. A right to receive or pay a fixed amount of money, not like the one that I told you of buildings of 30 million when we realize we may not be able to get that fixed money. Key features: fixed or easily measurable in money, cash or future payments. Value can be affected by exchange rate changes if in foreign currency. Examples include cash, accounts receivable, accounts payable, loans, bonds payable or receivable. Example, you have a Kenya shillings 1,000 loan payable in 3 months. That's a monetary item because it's fixed amount in money. You can't go to the bank after 3 months are over, you start telling the bank that now I'm going to pay you 950. No, you have to pay 1,000. All right. So in this case, that amount is fixed. It can't keep on fluctuating. How about the amounts we expect in this case here from our buildings? That building, of course, we expect, ladies and gentlemen, the figures here to keep on doing what here fluctuating depending on the valuation. Depending on the valuation. Now listen. Listen. So we are told here non-monetary, these are items that do not involve fixed monetary amounts. Their value can change based on market conditions. Like usage, like when I'm using this particular vehicle, it's depreciating. All right. Usage or age. Key features, not settled in cash directly. Their value is usually not directly affected by exchange rates. Examples, property, plant and equipment, inventory, intangible assets, all that. Now, gains or losses, the question now that the examiner asked you, gains or losses on translations. Monetary items, these are items like cash, loan, payables, receivables, money-based. Translate using the rate at reporting date. During this translation of foreign branches, foreign subsidiary, all monetary items shall always be translated at the closing rate or the rate which exists at the reporting date. Any exchange gain or loss will always go to the P&L. For monetary items, any exchange gain or loss shall always go to the P&L. Always go to the P&L. So key things you're learning there, ladies and gentlemen, whenever you're translating. If, for example, you have a parent company, and then you have, in this case here, a subsidiary which is based in Ethiopia, where they're making use of the birr. So here we have Kenya shilling because the parent is based in Kenya. There are those monetary items like receivables. So like receivable, maybe this could be 10 million. This could be like 30 million, all right? But you see, for consolidation, at the end of the day, you will need to translate this amount because it's in bills. You have to translate it. And you're saying that for us to translate this amount, we shall be using the reporting date, the end of the year rate. So you have what was reported in this year vis-a-vis what was reported at the end of last year. If there are any gains or losses, they shall fully be transferred to the P and L, fully. So any monetary item, whenever it comes to translations for purposes of consolidations, whenever we have many rates, will be given like historical rate, will be given average rate, will be given what we call closing rate. Those monetary items, we shall always use closing rate or the rate at the reporting date. And once in this case you do the translations, and then you realize that there is an exchange gain or an exchange loss, you shall be able, ladies and gentlemen, to book losses or gains in the P&L. But now remember, if you have got non-monetary items, ladies and gentlemen, are items like buildings. So buildings, basically you look at, when you were buying this building, what was the rate that was existing then? What we call the historical rate. So for non-monetary, we shall always be very, because non-monetary items, ladies and gentlemen, are quite significant. We'll be looking at for these foreign subsidiaries, these non-monetary items like land and buildings. When did we buy them? What was the exchange rate existing then? So the exchange rate that was existing then, we call it historical. Historical. Please listen. We are told here, non-monetary items, these include assets like land, buildings, or inventory. If using historical cost, use historical cost during the purchase date, or use fair value if there is a valuer who has come. Any gains or losses depend on how the item is treated. But most importantly, ladies and gentlemen, what I would want to sell to you here is that monetary items take the profit and loss. Monetary item exchange gains and losses take the profit and loss. And then non-monetary, you take to OCI. When I teach advanced financial reporting, I always like telling my students that if you do an exam, a FR exam, without really mastering that concept of OCI and the P&L, you'll get problems. So in this case here, for the monetary items, whenever you get exchange gains or exchange losses in relation to exchange differences, they shall always go to the P&L. And non-monetary, they shall always go to OCI. And then the thing is, don't cram. The thing is, you should be able to get, in this case here, just a high level understanding. So ladies and gentlemen, can I go to the next question? Remember, I was to be here for around 30 minutes. Have you been able to pick something out of this, however small? Have you been able to pick something out of this, however small? Have you been able to pick something out of this, however small? Please talk to me. Have you been able to pick something out of this, however small, out of this explanation? However small, you can say Y for yes, because you are here to build each other. Yes, and I can see Sir Charles saying there that our students are able to get help loans. Yeah, our students are able to get help loans if you're willing to. Yeah, I will be able to send. Yes, I'll be able to send. So if you're willing in this case here to work with our help experts, call the number that is giving us there, 011 70 90 000. If you want somebody to help you work out the help. Yeah, if you want this higher education loan board, then you can talk to us. We'll be able to help you out with how you're going to handle that. Now then, allow me to go straight away to the next concept, ladies and gentlemen, which is which concept? Very easy concept. I love this. IS-20 is my best because I've worked for a multinational organization which has been receiving grants for long. Yeah, so I really know how to handle this area. Question number 3, outline the accounting treatment of government grants related to income, accordance with the International Accounting Standards 20. So there are two types of grants, remember. According to IAS, there are two types of grants. According to IAS 20, you know, grants is normally given to you, for example, by government. Yeah, the government can easily come and grant you. You're being given money, which will not be required to return, not unless there are conditions which are put there and you don't meet those conditions. But basically, you're given money like for free. Go and use this money. All right. So we have two types of grants. We have, in this case here, grants. We call them income grants, and then we have asset grants. So there are those grants which will come to help you buy an asset, and there are those grants which will come to help you in your operations. So these are operational grants, and these are what we call CAPEX grants, operational grants and the CAPEX grants. CAPEX stands for capital expenditure. So operational grants are those grants, ladies and gentlemen, that we receive to just help us in our operations. Yeah, so for example, we have employees. This is something I've seen happening where I've worked before. So we have employees. These employees are supposed to be very productive. Then we have a donor who tells us that, hey, we are giving you this grant for employee training to enable them, in this case here, improve on their productivity. So for them to improve on their productivity, ladies and gentlemen, that's not an asset we are buying. That's an operational expenditure. And the IAS 20 is very, very clear on this. I love IAS 20. It's very, very clear on this. If it is an operational grant, otherwise, which we also call an income grant, there are two things. So you'll come here under your statement of income and surpluses, you'll have an income. So call it grant. Grant, you must elaborate. Training fees. Show the figure, maybe 10 million. Show the figure as an income to you. You show the figure as an income to you. There are two ways. You could either show it here or in your expenses. In your expenses, where you have the training cost, perhaps in the whole year it took you 20 million to train your staff, but you were given some grant by government. So the government, for example, gave you a grant of 10. So then I'll be able to report a reduced training cost because this burden was lessened for me. So there are two ways. Either you show it as a separate income here, or you go to the particular expense, here and deduct it. That is what we call IAS 20. And if you allow me, I'll be able to read here. Government grants related to income. These are grants given to support a business's income or operations. They are spread out and recognized in the same period as the related expense. Can be shown as other incomes, or reducing the related expense. Can be shown as other incomes or reducing the related expense. Example, a training grant of Kenya shillings 100,000 is received. If training costs are Kenya shillings 100,000, the grant cancels out the expense or showed as an income. I love that. That in this period, we had a training expense over 100,000. But out of these 100,000, it is a benefactor. Somebody came and they gave us this money as a grant given to us. And they gave us exactly what we needed to cover the entire training. So then we should be able to come and say minus 100,000, all right, which cancels the whole. Alternatively, you can come, ladies and gentlemen, here, don't deduct this. IAS 20 gives us the two options. Don't deduct that 100,000 there. Come and capture it here under incomes, under what we call other incomes. Just come and have what we call a grant, which in this case is training cost of 100,000. And simply because you have this training cost as an expense here, then when you deduct here, you're going to get a zero. You're going to get a zero. That is as good as doing what we call cancellation. So whenever it is an income or operational grant, ladies and gentlemen, what you're required to state in that question is that you shall be able to take this particular, income as a, book it as a separate income, yeah, or you go to the particular expense and deduct it. Go to the particular expense and deduct it. So if you allow me now, I'm doing the last question. We said we were supposed to be here for only 30 minutes. Yeah, so question number 5. I love this. In relation to international accounting standards, IAS 41, agriculture, explain the following. Recognition of biological assets and the measurement of biological what here? Measurement of biological assets. Measurement of biological assets. Now, ladies and gentlemen, I love IFRS. Because you see, IFRS, we basically keep on talking about what here? How do you do the initial recognition? And how do you do subsequent measurement? Anytime I hear about subsequent measurement, there are two possibilities. Cost method or fair value method. Subsequent measurement. You see, if I buy a vehicle today, initial recognition, what is the cost? Recognize it at that cost. But now moving forward, it will be net book value. So it is cost minus depreciations. We call that one the cost model. Subsequently, this vehicle, I may want in this case to call in a valuer, especially when I'm taking insurance. So if I call a valuer in, then I'll be using what we call fair value method. The same is applicable to the cows. When it comes to measurement, ladies and gentlemen, measurement, these cows, remember the agricultural assets like cows, crops, etc. Ladies and gentlemen, they normally go through what we call biological transformation. They grow. So given that they are growing, then cost method can never be an option because there is no depreciation there. It's transformation, increasing growth. So cost model can never be an option, right? So please listen as I read here very, very fast. What are we told here? We are told IAS 41, agriculture recognition. You can only recognize when you do what here? You own / control the asset, e.g. cows, crops. You know you can't recognize something which is not yours. When it is expected to bring future benefit. And then number 3, ladies and gentlemen, you can measure the value. Example, a cow that will produce milk is recognized as a biological asset. Now, you know there are animals that you can't recognize as a biological asset. There are animals you can't recognize as a biological asset. We'll be talking about this later. But one thing, and you can see this in your past papers. Often, ladies and gentlemen, you can see this in your past papers every other day. Assets can only be recognized if, in this case here, you are able to do what here? You are able to control them. Or in this case here, you do what here? You own them. Or you own them. You are able to control them, or you own them. Number 2, there must be a benefit attached to that asset. Yeah. There must be a benefit attached to the asset. There must be future cash flows. And then in this case here, you must be able to measure this particular asset reliably. Ladies and gentlemen, please listen and listen to me very well. We're discussing something very important here. We are saying measurement of biological assets, measure at fair value. Of course, if there are any cost to sell, you always subtract them. So measure at fair value, all right, less cost to sell at the reporting date, and any changes in value will go to P and L. Any changes in value will go to P and L. Example, a cow worth 50,000 last year is now worth 60,000. Last year it was worth 50,000. This year it is worth 60,000. So you can see there is an increase in value of 10,000. The Kenya shillings 10,000 increases will go to the P and L. I can see a question here. I discuss asset grant. Yes, I'll be able to discuss asset grant. Just give me 1 minute. Great. Yeah, please feel free to ask questions. Just give me 1 minute. I clear this question and then I go back to asset grant. All right. Now from there, ladies and gentlemen, they're asking us to talk about IAS what year? IAS 19. IAS 19. What do they want us to talk about IAS 19? Is there somebody who knows IAS 19? IAS 19 is amongst those easiest IASs. I love IAS 19 because it talks about the future. It talks about our future. Now, ladies and gentlemen, I don't know whether there is anybody who has ever seen. Do we have anybody who has ever seen the CBK towers? I have to look for this. CBK towers. CBK pension towers. CBK pension towers. Pension towers. So I'm looking at the photo. I have to search for this, and then I show you something very, very important here. Yeah, great. Here I am. Now, ladies and gentlemen, this is what we call the CBK towers. You can see the inspiration. The architect who drew this, he drew something that is bending, yeah? And there are two twin towers. There are two twin towers, and these twin towers, ladies and gentlemen, look like this. They look like this. So we have a strong base. We have one tower bending like that, and then the other tower bends like that. Yeah. So this basically, and remember, these are the CBK pension towers. Pension towers. What does this mean? It means at the end of the day, it doesn't matter how strong you are walking today. You could be a tall lady who is able to walk on their high-heeled shoes very, very well. It's your age. You could be, in this case here, a very strong young man, yeah, who can even go out there and box. It's your age. Great. But whether you like it or not, when you hit age 70, you will have to bend somehow. There'll be some bending to be done. You will get old. And that is why this CBK pension towers, ladies and gentlemen, has a very, very important inspiration. Has a very, very important inspiration that try, when you are young, with all your energies, try to make your base for your future very, very strong by investing in pension today. Start by investing today. So that by the time you are bending, you'll be having something to do what year? To fall back on. When you are bending, you'll be having something to fall back on. When you are old, you'll start getting so many diseases, etc., etc. You need money to move around. You need money to move around. So then we shall be able to have two types of pension schemes. These two types of pension schemes discussed under IAS 19, ladies and gentlemen, you know them. You know them. Yeah, we have what we call defined contribution plans and defined benefit plans. Very easy. So we have defined contributions. And then we have defined benefit plan. So I worked for a company called Arrow for so long. Arrow is a Swedish organization, but based in 140 countries. Now, some of these organizations, like now this organization, does not want their employees to suffer when they retire. So normally what they do, they look at your current status, and then they do a projection. Today you are earning $1 million. Come in this case here, I mean, when you retire, to be able to live the same lifestyle that you are in today, how much will you need to be getting on a monthly basis? So like now for Arrow, we had what we call a defined benefit plan, where your employer is able to guarantee you how much will you receive when you retire. It's called, the benefit is given in advance. It's called a defined benefits plan. So, but this is very risky. You must be a very solid organization for you to be able to define the benefit that your employees will be receiving like 30 years from today. You must be a very solid organization. Not many organizations can be able to guarantee that. Because first of all, are you sure that you will be there at that time? No. So then what most employers do is to transfer the risk to these pension schemes. Like as a RCM, we work with Britam. So under Britam, what do? We contribute money to Britam scheme for our employees. Yeah. So in this case, we were able to put in 6%, and the employees, we expect the employees to put in 6%. That is 12% of their gross. So every month, this money goes to this pension. So assuming, let me ask you a question. Assuming, ladies and gentlemen, that we have been making these contributions every month, we are paying for somebody 10,000, we are paying for somebody 10,000 to the Britam scheme. Let me ask you a question. These are the contributions that we are making. We have defined the contributions. The employee knows that we are taking 6% from his salary and we are adding 6%. So we have defined the contribution and we are giving Britam this money to run it on the behalf of employees. But let me ask you a question. What if, ladies and gentlemen, in 20 years' time, Britam will not be there? Britam collapses. God forbid. It's a big company, it can't collapse. But if it collapses, how much do you think will the employees, our employees, get as pension? How much do you think will our employees get as pension? Please talk to me. How much do you think will our employees get as pension? Please talk to me. I'm giving you 1 minute. So we have been making contributions to this scheme, and the things happen. Unfortunately, the scheme has collapsed. What do you think will happen? Please talk to me. Unknown, I love that, yeah. Unknown. Me, I know how much they will get. I know how much they will get. I know how much they will get. Is there anybody who could be knowing how much they will get? Any other person who could be knowing how much they will get? You see, if Britam collapses, then these guys will get a zero. These guys will not be able to get anything. They will get zero. All right? And they cannot come back to us because we signed a contract with them. It was a tripartite contract, a contract between the employer. We have in this case here, bankruptcy here. We have the employer. We have, ladies and gentlemen, we have the employer here. We have the employer and we have Britam. And we were able to transfer all our risks to the pension scheme. So in case the pension scheme decides to give them even more than would have given them, none of our business. If the pension scheme does not give them anything at all, none of our business, because we never defined any benefit. So for us, what have we been doing? For us, we have been contributing. It's called defined contributions plan. And then we have what we call a defined benefits plan. So we are saying, ladies and gentlemen, here, defined contribution plans, they ask us to do very simple things here. Types of post-employment benefit plans in accordance with IAS 19, employee benefits. So we have here defined contribution, the employer pays fixed amount. No extra promise later. Employee takes the risk. Example, the NSSF is a defined what here? Is a defined contributions plan, because we are simply contributing, ladies and gentlemen. We are simply contributing, ladies and gentlemen, so that this NSSF will be able to take care of what are these employees in the future. That's all. And then we have, ladies and gentlemen, in this case here, what we call defined benefits plans. Defined benefit plans. So under defined, the employer now, because he's rich, he's a multinational like Arrow here, is able to set a particular amount that he'll receive upon retirement. It's based on years worked under salary. The employer now bears the cost and what year? Bears the cost and the risk. Bears the cost and what year? Bears the cost and the risk. All right. So, ladies and gentlemen, that is the end of those questions that were done. The employer now bears the cost and what year? Bears the cost and the risk. Bears the cost and what year? Bears the cost and the risk. All right. So, ladies and gentlemen, that is the end of those questions that were done last semester by the FR students, the theory questions. I'll be doing these others later, the computational ones later. But you see, the moment you're just so good in theory, let me tell you a secret, even in financial management, advanced financial management, strive always to be very practical with your theories. The moment you're very, very good with your theories, you can never, ever go wrong. Yeah, like now this, you can see theories were about 30%. Or to be pessimistic, more than 25% you can count. Yeah. If you get 25, and then of course you need very little from the other section to be able to survive. You should never fail any 𝗖𝗙𝗙𝗘 exam, because the theories are normally lifesaver. All right, somebody had asked me a question here about these asset grants. Remember now, assets, ladies and gentlemen, you will receive this. You will receive this, of course, in the bank, for example, if the money has been given to you. Yeah, so they have given you money to buy an asset. So you'll be able to receive this in your bank. And then, of course, you will credit what we call deferred income. Deferred income. Why? Because remember, this asset is coming to stay with us for a longer period, more than 1 year. Just like how we do the depreciations. So as you utilize this, we shall be crediting our deferred incomes. Then remember, we have got what we call conditional grants, etc. But these are things we shall be looking at now in the future. Otherwise, it has been a pleasure hosting you this morning. I would want to take this opportunity to welcome all of you to RCM College. RCM College is your home, is your home, is your home. So if you need, in this case here, for example, to study with us using the help loans, yes, this we shall be able to ensure that you get them. Yeah. For those of you, of course, you know, who may want internships, etc., we always help here, especially through our audit firm, 𝗖𝗙𝗙𝗘. 𝗖𝗙𝗙𝗘, although I prefer somebody who has already done this IFRSs. I prefer somebody who has already done the IFRSs. When you are at your advanced level, then we can talk about internship, not immediately. When you're down there, you'll become a liability to us. Otherwise, thank you so much. I'm looking forward to teaching you this semester. Don't forget our number. Don't forget our number. Our number is 0793 555 000. I hope you enjoyed the session. Thank you and bye. The document, do you want me to attach it here? Do you want me to attach it here? Do you want me to attach it here? I can attach it here. I can attach it here. Very fast, yes. I can attach it here. Very fast. Not the best. Let me just send it in the group. Let me send it in the group. Let me send it in the group because I can't see. I have to download it. It will take time. Thank you so much. Let me just send it in the group. To WhatsApp, yes. All right. Okay. Asudi, let me just send it to the group. Let me send it to the group. Thank you.